All right, today we're pulling back the curtain on a really critical piece of our financial system. It's something that was born out of crisis, and it works silently, day in and day out, to stop another one from happening. We're talking about trade repositories. They're basically the invisible guardians of the entire global economy.
So let's start with the big one, the question that keeps regulators and economists up at night. The 2008 crisis, it was a seismic shock to the system, right? A near total meltdown that was fueled by these huge risks that nobody could even see building up. But what if I told you that a global network was built for one specific reason? To make sure that kind of blindness never, ever happens again.
This really paints the picture, doesn't it? Before 2008, the derivatives market, which is just massive, was a complete black box. It was opaque, everything was disconnected, and it was the perfect place for risk to just grow and fester, completely unseen. After the crisis, the mission was crystal clear: bring all of it out into the open. The goal was to make the system transparent, centralized, and constantly monitored.
So to really get why this solution is such a big deal, we have to go back and appreciate just how big the problem was. Let's rewind the clock to the days before 2008, to a financial market that was pretty much operating entirely in the dark.
This quote just nails it. The over-the-counter, or OTC, derivatives market was where banks and other big institutions made these huge private deals. And the problem was, nobody, and I mean nobody, had the full picture. Regulators had no way of knowing how deeply connected all these firms were, or who was going to be left holding the bag if a big one, like Lehman Brothers, suddenly went under.
Okay, so after the crash, world leaders got together and basically said, never again. This has to change. The mission was to turn on the lights. And that kicked off this huge wave of new rules, all designed to drag this shadowy market out into the sunshine.
And this wasn't just one country acting alone. It was a truly global effort. Over in the US, you have the Dodd-Frank Act. In Europe, they created what's called the European Market Infrastructure Regulation, or EMIR for short, and both of these massive landmark laws had the exact same core command. If you're gonna trade a derivative, you have to report it. And all that data, it had to go somewhere.
And not somewhere is a trade repository. The concept is actually pretty simple, but it is totally revolutionary. A TR is just a giant, centralized database. Every single derivative contract from every major player gets logged right here. So suddenly, for the very first time, regulators could see everything, all in one place.
Look, if you remember just one thing from all of this, let it be this analogy right here. A trade repository is like a flight data recorder, a black box for the entire economy. It's recording every transaction, every position, every single connection. So if something starts to go wrong, if a firm starts to get into trouble, regulators can look at the data and see exactly where the stress is building before it has a chance to take the whole system down with it.
Okay, so how does this all actually work? How does the information from one single trade end up in this massive database? Well, as you can imagine, the process is highly technical, and it demands incredible precision.
It all kicks off the second two banks agreed to a trade. Now, under these new rules, both of them are legally on the hook to report hundreds of little data points about that trade to a repository, usually before the end of the day. They create a special code to link their two separate reports, and then the repository's computers get to work, checking, validating, and matching everything up.
Now, the absolute key to this whole thing, the piece that makes it all work, is something called a Unique Trade Identifier, or UTI. The best way to think about it is like a unique fingerprint for the trade. Both sides put this UTI in their report, and it acts like a digital handshake. It allows the repository to take the report from party A and perfectly match it to the report from party B, confirming they're both talking about the exact same deal.
And when I say the data has to be perfect, I mean perfect. We're talking about hundreds of fields that have to be formatted in these really specific, complex ways, like XML. The whole world is now moving to a global standard called ISO 20002. Just to make sure that a trade reported in New York looks exactly the same as one reported in London or Tokyo. There's just no room for error.
So building this global system has been a monumental achievement, for sure. But let's be real, it hasn't been a walk in the park. So let's take a look at the real-world impact, both the incredible successes and, well, the immense daily struggles.
The successes are just undeniable. For the first time ever, regulators can spot these dangerous buildups of risk that were totally invisible before 2008. They can find and expose market abuse. And there's been this powerful side effect. It's forced all the banks to get way, way better at managing their own data. Why? Because now, making a mistake can lead to some very hefty fines.
And the scale that we're talking about here, it is just staggering. The total estimated value of this market is over $600 trillion. Trillion, with a T. That's the sheer size of the financial world these repositories are responsible for watching over every single day.
But here's the catch, and it is a huge catch. For this whole system to work, it demands absolute, uncompromising perfection. The biggest challenge isn't just getting the data sent in, it's making sure the data from both sides of the trade matches perfectly, down to the very last decimal point.
So here is the problem in a nutshell. Just look at this example. The UTI matches, that's good. The product is the same, the date is the same, but look at the notional amount. Counterparty A reported $10 million. Counterparty B reported $10 million and $1. That tiny $1 difference creates a mismatch, and to the system, that's not a small error, it's a complete failure. The trade doesn't reconcile.
A single error, like that one, it triggers an immediate alarm. All of a sudden, you have operations teams at both banks scrambling to figure out what went wrong, find the source of that $1 error, fix it, and then resubmit the report. And if they don't do it fast enough, or if it happens too often, they can face some really serious fines. It is a constant, high-stakes global battle for data perfection.
Okay, so let's zoom out and bring this all together. We've been deep in the weeds of data and regulation. So why does this complex, invisible network actually matter to those of us who aren't on a trading floor?
Here's why. Because this system, with all of its technical headaches and challenges, is our global safety net. It's the thing that makes the bank where you keep your money safer. It's what makes the pension fund that manages your retirement savings more secure. By giving regulators the tools to actually see and manage risk, it makes our entire economy just a little bit safer for all of us.
And that kind of leaves us with a final big question. The creation of these trade repositories was a massive bet. A bet that in a financial world built on data, radical transparency isn't just a nice-to-have, it's the ultimate defense. The question now is, will it be enough for the next crisis, the one we haven't even imagined yet?